Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Let's take a look at what we got today. We got some great things to talk about, make you a smarter investor. Wow, how much will the EV car makers lose in credits? They're losing those credits. We'll talk about that. It's going to be some big effect on some of those EV car makers. Very important for investors. Stay away from interval funds. We'll explain these to you. They're being sold. We don't want you getting into those. We'll explain why not and why you don't want them. And then lastly on the topics here, ESPN. They just launched a new streaming product. And I got to tell you, I'm more confused than ever. What to stream, what to get. Please bring me back the old days of cable.
Companies we're going to look at today, too. We got some good ones. We're going to take a closer look. You might not be aware of this name, but it's called Ventas. It's a senior housing stock. So kind of curious to take a look at that, have some interesting numbers. Also going to look at C3AI. That stock has fallen quite a bit in the AI space. Also going to look at KinderCare Learning Companies. My alma mater. I went to KinderCare when I was a kid, I remember.
You did?
I did, yeah.
I kind of remember that.
Yeah, it was right off Pomerado Road there. Yeah. And then last company we'll look at is Brinker International, the owner of Chili's. So some good stocks, as always, break down the fundamentals, giving you an idea if we think it's buy, sell, or hold based off the valuations, the balance sheet, and everything we see here on air.
And Chase, before we get into the topics, we need to make a quick comment on yesterday. Federal Reserve Chairman
Jerome Powell,
thank you, spoke at Jackson Hole, and he made some comments, and the markets loved it. They went up dramatically, and this is great. He's going to cut interest rates. But there's concerns I have that, and we enjoyed the rally like everybody else did. We are kind of cautious. But there's some things in there that we said, well, wait a minute. It's still about 3 weeks away before they set the rates. A lot could change.
Yeah, I mean, I guess the key words that he used was with policy in restrictive territory. So he's admitting that obviously interest rates are high because they're restrictive. He said the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. So that is what I think got the market excited. Kind of sounds like rate cuts coming, but you're right. I mean, the data isn't in the books yet between now and the meeting in September. So I think we'll have to see. I even think it could be problematic too. I mean, now they're expecting a rate cut. Even if you get a rate cut, it's almost baked in. I think the expectation sounds like 90% for it.
Yeah.
I think he might be forced to cut now because if they go into that meeting and set 90%, if he doesn't cut, the market would falter dramatically.
And I hope he doesn't feel that pressure because he is supposed to be setting policy for the longer term, more worried about inflation. So I would like to see a rate cut, but I don't want to have him do it just because there's pressure to him. And then we do have coming out between now and then, we got the PCE, which is Personal Consumption Expenditures Price Index, coming out pretty soon. We've got another jobs report, and he felt really kind of downbeat on the jobs because they weren't there. What if that reverses? And we got 100,000 jobs that were created in September. And then also another CPI report that if that's a negative, he could have to change his mind. I don't want him locked into that because perhaps the economy's not as bad as it looks recently. So that could all change. And then you're right. If he doesn't reduce rates, markets will fall. But, again, we're not.
Even if he does reduce rates but doesn't give a optimistic outlook to cut rates further, that could be a problem. So, I mean, again, enjoy the rally. But, I think that everything this year is just setting up for perfection. Everything just has to keep going the right way. And just being realistic, we know there's going to be a speed bump that comes. And with valuations high, that's generally a dangerous area to be.
And what we talk about doesn't mean you put all your money in cash or money markets. What it means, you're cautious. You have maybe 20, maybe 30% of your money in money markets or cash to be cautious in case things don't go that way. Because, again, 3 weeks in Fed speak is a long time.
Yeah. So I'm still pretty optimistic they're going to cut in September.
I'm 50-50.
I'm I'm like pretty darn close they're gonna cut.
I'm data dependent. I'm waiting for the data to come out before I say what to happen, and hopefully they do as well. But let's move on and talk about ESPN, because they just launched a new streaming product, and I gotta say, I said I'm more confused than ever when I'm watching TV. What am I watching? What am I paying for? What am I getting? I forget all these different things, and companies seem to keep increasing the prices for their services. I remember, going to streaming is going to save you money. Well, that's not happening. But just this year, Netflix increased their prices for various tiers, but the tiers with ads went from $6.99 to $7.99. Not a big deal.
And then if you don't pay for ads, or if you pay not to have ads, I think it's like $22.49 or something a month.
And I'm not going to watch ads. I want to watch it. I want to get in, get out. Peacock went from $7.99 to $10.99. Apple just recently went from $9.99 to $12.99, and they've been very aggressive. When was it? Just 3 years ago, Apple was $5, so they've more than doubled. That's up about 120, 140%.
Yeah, I mean, I think Apple is the worst value. I mean, at $12.99, I don't. They had Ted Lasso. Supposedly Ted Lasso's coming back. That was really the only show I watched there, but I wouldn't pay $12.99 for Apple. I don't think long term.
Do you still have Apple or no?
I do, because T-Mobile pays for it. So
you don't really pay for it.
Yeah. So
you got T-Mobile?
My wife does. Yeah.
Oh, wow. That's
obviously I have Verizon, but
yeah, I know you have the company Verizon, but your wife. What's wrong with your wife? No, I know.
T-Mobile's good. If we didn't have Verizon, I'd probably be at T-Mobile.
We had people that go to our house. They say, "I got T-Mobile. I lost service."
I had friends. When I go back to their house back off Garden Road, Verizon never worked back there.
Really?
So
I guess
it just depends on the network.
I guess the hear me now is no longer true for Verizon.
But back to streaming. I mean, what we're looking at here, the news of streaming this week was ESPN just launched its new service to allow consumers access to its programming without needing cable. ESPN had ESPN Plus for years, but that didn't give you access to like Monday Night Football and a lot of the main games that people wanted to watch. But I mean, the price is, I'm going to say, pretty darn high at $29.99 per month. And also, too, Fox was another one that just announced a new streaming service. But Fox, I think they're calling it Fox One. That's going to be priced at $19.99 a month. I do know that they have bundles that you can choose from, where Disney and Fox are going to have a bundle. I think it's $39.99 a month. So instead of paying $50, you're paying $40 a month. Again, just complicated. There's a lot going on.
And what I'm hearing too, just to watch sports, it's going to cost you $40 a month. And then, well, let me continue on here, because I got more things I want to say on that. But I do want to talk about how you add these services to others like Disney Plus, Paramount Plus, HBO Max, Hulu. And the cost, well, it's just getting ridiculous here. It's just going up and up. And I remember the cable, like I think I was paying back before they went to streaming. I think it was like $150, $180, but I had the DVR, which I could watch anything I wanted, and then I could just pause it, skip the commercials, everything.
The problem, though, is they've segmented it. So if you want to watch something on Netflix, you have to have cable and Netflix.
Yeah. And that's what's kind of frustrating, is that you're not saving any money. They fooled us.
They fooled us, right? And they confused us.
They confused us.
And I got to say, I mean, gosh, I'm a big football fan. And, you know, I love watching the NFL every year. I like watching some college football, but now with two kids, I think I got to pick one or the other. I think I'm going to stick with the NFL. My brother and I always watch the Charger games together. And don't hate me, I used to hate the Chargers, and now I just realized I can watch their games for cheaper than any other team. So I went back to being a Chargers fan. But what the NFL, they split the games into so many different providers that if you want to make sure you can watch all the Charger games all season, you're basically forced into now subscribing to Fox, ESPN, Peacock from a Sunday night football, I believe it is, Paramount Plus for the CBS games, Amazon Prime now carries games, and then now even Netflix carries some games. So you got to have all the streaming services if you want to ensure that you can watch all the Charger games or all the football games that you want to watch that year. And that doesn't even include if you throw in Sunday Ticket to get out-of-market NFL games. That's going to cost you $480 for the whole season. I mean,
so
it's just gotten terrible.
$80 a month maybe for that.
Yeah, probably, because it's about 4-ish months long, right? I mean, September to.
So if you're a big football fanatic, you could easily spend. I'm just adding up the numbers, like $200 a month to get everything, probably. To watch everything you want.
Yeah.
Wow.
So I mean, it's.
Give me my cable.
Well, I mean. And to be fair, if you wanted Sunday Ticket when you had cable, that was still an additional add-on. So I mean, it wasn't that different. I mean, if you wanted to watch all football games, it was still going to be more costly. And we defer here. I think streaming's great because it gives you flexibility. Right now, the only thing I'm paying for is Peacock, and that's costing me $10.99 a month, which is way less than what I pay on cable. But actually, that's not true. I do have CNBC Plus, which is $15 a month. So I'm paying $22 a month. But when I have football season come back, well, now, yeah, I'm going to have to pay the, $40 a month for Fox One and ESPN.
Yeah.
But that's still only $62 a month, which is cheaper than cable.
Yeah, but you're only doing sports. Maybe the wife wants to watch movies or some other programs.
I have Netflix. She loves Peacock, all the drama shows. So.
Yeah, but you said Netflix doesn't. What does that include? The football?
T-Mobile pays for my Netflix.
How long does that last? They're not going to pay for it forever.
Hey, I'm going to keep it as long as they allow it. Right now, there's no term on it, so they pay for it, and I'm going to keep that going.
Yeah. No term on it.
Yeah, they just say it's not like an introductory promo. Like they'll pay for your Pandora for year one, but Netflix, it just says they'll pay for it. So.
And you got a question: where's that money coming from? Because
maybe they do charge maybe more for other things, so it maybe an offset.
But I mean, somebody's got to pay for that.
Oh yeah, it's not free.
T-Mobile paying for it. Somebody's paying for it. So it's just. It's become so confusing. I'd love to say it's going to get easier, but I don't think it's going to get easier. I think it's going to be more complicated.
But, I mean, as a sports fan, I would love if more sports went like the Padres, or I know some NBA teams did it, where if I could just subscribe to the Chargers and watch all Charger games, even for $30 a month, that would make my life so simple. But
yeah, not going to happen. Maybe, yeah, not going to happen.
I mean, maybe the Padres do it now for $20 a month. But the issue is if they're on, like, prime time on, like, Fox or something else, you can't get the Padres game through your subscription, I don't think. I think you then have to watch it on Fox.
Yeah, but then if you want to watch a Yankees game, oh, sorry, now you got to do something else. So
I'm just saying my personal preferences.
Well,
because I'm important.
Everybody has personal preferences, which are different, and that's what makes it difficult. Let's talk about investing and tell people why. Do you want to stay away from these interval funds? I'm sure your brokers try to sold them to you. They've been sold quite a bit. I've been seeing more and more of these interval funds when we take over accounts for new clients. And let me tell you, we are not a fan at all of these. They appear to be like normal-looking mutual funds, but the key is when you go to sell them, well, you find out you can only sell once per quarter. What?
Yeah, and I've seen this now many times, and it comes over, and you're like, oh, okay, great. Yeah, we can get into the way we want to manage money, especially it's very irritating in IRA because you don't even have to consider tax considerations. And you're like, oh, and then if you miss that date once per quarter, well, now you got to wait a whole another 3 months before you can even try and sell it again. But the other problem is when you enter the sell, the next day you realize you still own shares in the fund. Why is that? Well, the products have a unique structure that typically allow investors to just redeem 5% of a fund's assets. So let's say every single shareholder out there wants to redeem shares in that fund. You'd only get 5% of what you own in that company. And the problem is you're getting smaller and smaller, right? So your pro rata allocation in that, you might sell, let's say, $5,000 one quarter, but now since you have less, now you're only selling $2,000. So it gets smaller and smaller, and you're not getting out of it. I mean, it's just terrible.
You're always going to have something because your pro rata always stays low. So they'll keep it forever. You're married to those guys forever. So stay away from them. And I'm sure most people have no idea that their advisor or themselves have actually got these funds, and you're locked away for years. And for example, I first saw this about 4 years ago, the new client, and this was 4 years ago, we're still not able to get out of complete that fund for what you just talked about. You keep getting the percentage amount, which is small and small. I mean, that can go on for an infinite time frame.
Yeah.
Yeah.
If other people want to cash out, yeah, you're screwed. Yeah. Now, if you're the only one cashing out, you can get out, but I mean, it's a pain. And I mean, I understand why the withdrawals are limited. Not that I agree with it, but the reason they're limited is because the funds generally invest in our favorite things, illiquid assets. So managers want to make sure investors can't exit en masse and force the manager to sell securities at fire sale prices. So, I mean, that's why they do it. I understand it. But we would never recommend investing in illiquid assets to begin with. This is just another illiquid asset.
And I think that's a taste of the future problems to come when you have a major problem, major recession, and those assets are illiquid. There's going to be some major problems, and the interval funds are just a beginning.
Well, I mean, we talk about this all the time with illiquid assets. The problem is when it's going up, it's fine. You don't really care. You don't want to sell because things are good. But things turn and go south. they're still illiquid. You can't get out.
You can't get out of them. They're liquid. And the allure here for many is that retail investors with less investable assets generally don't have the same access to this as many private equity, venture capital, real estate, and private debt deals. So interval funds enable people to get those with a minimum of maybe $1,000. You're getting exposure to this space, which I don't think is a good thing. And I would not recommend these at all. What really bugs me on these is where they're sold like, well, this is what the wealthy's doing. Yeah. So here for $1,000, I can sell you this and you can invest like the wealthy. No, I hate that. If you hear that, walk away from your broker because he is selling you a product.
We have many wealthy clients.
Yeah.
None of them are in these, so don't feel like you're missing the boat.
And some have had them, and they got burnt on them, and they go, I don't ever want those again.
Let me rephrase that. We actually, I think, have 5 of these funds in our portfolio
that we can't get rid of.
We can't get rid of them.
And they want to get rid of them, and they're terrible performance.
I mean, I will say some of them have done okay, but just because something's done okay doesn't mean it will do okay going forward, and we'll get into that. The issue I see with these funds that a lot of people don't realize is the fees. They're just insane. I mean, Morningstar, they looked at 307 interval fund share classes that are currently available. Get this, the median fund's total expense ratio is 3.02%. So if you're paying advisor, let's say 1.5%, you're paying 4.5% essentially to have that fund. And a big reason for the high fees is they include the cost of leverage, which these funds use in many cases to amplify the returns. Wow, that sounds good, right?
That's great.
That doesn't sound risky or anything. I mean, goodness. But even if we include the cost of leverage, the median expense ratio is still 2.18%. I mean, these funds are just, wow, you're getting raked over here, and Wall Street is getting the ones that are making money from this.
And I'm sure when that's sold, that product's sold to you about, oh, the wealthy are doing this, know what they tell you. And by the way, the fee internally that you won't see is 3%. I don't think they'll ever say that, no.
Sure not.
And actually from Morningstar, Brian Moretti, he's a fixed income strategist team, had some interesting things to say researching the space. He concluded before deducting any fees or incorporating any leverage, there was little difference between private credit interval funds and public bank loan mutual funds and exchange traded funds. And we've done those private bank funds before, public bank funds before. However,
no private bank funds. We only do publicly traded securities.
Yeah, I think the senior floating rate funds. And that's kind of what these are. And as I said, interval funds have beaten traditional loan and high yield bond funds as they had about 1.3 times exposure. And you kind of talk about this on average to such debt in a rising market. But that's in a rising market. Markets don't go up forever. And just think about this. Yeah, that 1.3 is great when things are going up. It reverses when it goes down. It's going to have you lose more money quicker. And by the way, you can't get out because, sorry, it's not the right quarter. You got to wait for the quarter to end. And you can only take 5% as you see these things dropping and dropping.
Yeah, I mean, it's terrible. So I just want to kind of reframe that. I mean, the only reason, essentially, according to Mr. Moretti's research, that these funds are outperforming is because of the use of leverage. It's kind of like if you have a doubly levered S&P fund, let's say. Well, yeah, of course you're going to beat it in a rising market.
Right.
But all of a sudden things go down. Now you're losing twice as much.
Yeah.
Maybe even more because they use derivatives. This is potentially a similar issue, and leverage is terrible for people long term, in my opinion, because things are great when everything's fine, but all of a sudden that dime flips. Leverage destroys people. Yeah. It destroys investments. It destroys consumers. Being over leveraged is a huge problem. And I saw that. I was like, wow, that is not good. I think we could have a potential leverage bubble in many of these different asset classes.
Oh, I no doubt about it, because it is going to happen. We go through these cycles. Right now, we're in kind of the boom cycle. It's going to reverse. And when it reverses, people will lose billions of dollars.
Potentially everything. If you have leverage, you could lose everything.
Yeah. And I do worry about the future. I think it could make 2008 look like a...
It seems the leverage is more hidden this time around. I keep reading these different things, and you wouldn't see leverage on the surface, but you dig in and you see more leverage in these different products that you weren't aware of on the surface, and that to me is very dangerous.
Well, it's like the CMOs. They were kind of hidden as well. So all this stuff is hidden, and it will come back. You'll have to pay the piper eventually. Let's move on. I want to talk about quickly about how much EV car makers lose in credits because things have changed. The National Corporate Average Fuel Economy, or CAFE, standards are still in place. However, penalties for violating these standards have been removed. So obviously, there's no incentive for any car maker to abide by them.
Yeah, and if you look at the National Highway Traffic Safety Administration, that's a mouthful, they're focusing on standards to try and make cars more affordable again. But the big EV car makers, I'll call them the big three, which is Tesla, Rivian, Lucid, well, they will have some difficulties. The credits were tradable, and the EV car makers were making a lot of money selling the credits to car makers who were not meeting the required standards.
Yeah, and Tesla will probably be okay. I mean, they're the big one, but I think their stock could be at risk because of credits. I couldn't believe this, have amounted to $12 billion in revenue that they've received from the government since 2008, and that essentially, that's pure profit. There's no cost to it all, just given to them. In the most recent quarter, Tesla said a loss of revenue, credit revenue, reduced revenue by, and this is a quarter, $1.1 billion reduction in revenue.
Yeah, and profit.
Yeah,
I mean,
exactly,
that's the bigger issue. It's
Yeah.
like you're talking about it, because again, you're not producing any more cars to get that revenue.
No.
That is just what you've already done, and you're getting that on top. And the reason they were benefiting, I kind of looked at this, but it looks like the CAF rule, I'm going to call it that, CFAE rule, the goal was to have a 50.4 MPG by model year 2031. So all the automakers that weren't above that standard, that's why they had to buy these credits. And again, I think that's just silly in my opinion, but I mean, it's been a huge benefit, as you said, to Tesla. Rivian, another one. And their stock price in May finally showed some sign of hope, trading above 16 a share. That has now dropped back down to somewhere around $12 a share. And they said they had received over $400 million in revenue over the years, and the credits accounted for 6.5% of the total revenue in the first half of 2025. I can't even imagine what this company's losses would be, because again, they're not making profits, if they didn't get that $400 million. I mean, it's a huge problem for them. I gotta say, I mean, with the loss of these credits and the lower gas prices, Rivian could have trouble staying afloat in the future years.
Well, again, we talk about the big three EV makers, Tesla, Rivian, and then the last one is Lucid. And they'll probably be hurt probably the most. As they said, credits represent a significant amount of their revenue. I have not looked at this company recently, but I still believe their balance sheet looks risky, and this could be the final nail in the coffin for this business. A couple of years ago, the stock was trading around $4 a share. It's now trading just above $2 a share. I'm pretty confident this company is headed to the graveyard here. I mean, it just, without those credits, they have, well, they have no profits now. They have less. They got bigger losses.
and people were interested in maybe funding these companies because of the potential for credits, because of the potential for profits. Now with this and less excitement around EVs, who is going to be left to do the funding rounds? Right. The pool is shrinking, which is giving them less capital. And once you run out of capital, game over. Yeah. The winners in this situation, legacy automakers that were buying the credits. GM, for example, has spent $3.5 billion since 2022 to purchase these credits. Complete opposite of Tesla, right? Yeah. Tesla was a pure benefit to profit. GM, it's a pure cost to profit. It's just a check that they have to write every single quarter, every single year to make sure they're getting these credits. So, I mean, that should be a nice benefit to, I'm going to say probably GM, Ford, Stellantis, those legacy, the big three legacy automakers.
And I believe people should be able to get what car they want, EV or ICE vehicle, whatever you want. But it's just, I think the EV makers having a hard time. Gas, not here in California, unfortunately, but across the country. Sometimes I've heard it's like $2.50 a gallon. Why would you go out and spend extra for an EV car?
I mean, I still haven't done it even with gas prices here.
Well, yeah, I mean, gas prices, I think I paid for, I get premium now. I think $4.60 I think I paid for premium. But, yeah, better than.
My Suburban is costing quite a bit to fill up, but, you know.
You're going to have all those kids. You got those kids. You got to have that family van.
Exactly.
All right, let's move on here. Gosh, time just goes by so quick here. Let's talk about Veritas, which is
Ventas.
Ventas. Veritas is something else. Ventas, sorry about that. It is a REIT. They're in the healthcare facilities. Now, I thought you said they were a senior. They're put in the healthcare facilities area.
I guess healthcare facilities, yeah, but they focus on senior housing.
Okay, well, senior housing, so I guess that could be healthcare. Short on the float, only 4.4%. Not a good PE ratio here. And again, we do talk about FFO, funds from operations. This is PE ratio. I don't know if you'll have the FFO or not, but
I do.
good. PE is 158, very high, but price to sales 5.6, better than the industry at 7.1. Price to book value 2.9, that's tangible book value versus 10.6, that's a positive. Price to cash flow 19.5 versus 21. PEG ratio very good, 2.6 versus 39. Now over the last year, no growth on the earnings. Industry was up 143%. Sales for the company were up 12.5%. Industry up 38.1%. Now, this is why we'd want to look at this. The 5-year earnings per share growth estimate from the analysts, 58.5% versus 7.8% for the industry. So this is a positive going forward. This could be something growing in the future as our population gets older. Disappointing, the dividends, only 2.8%. And the payout ratio, 413%. So they're not having a lot of profits. Again, we'll see what you have for the FFO there. Let's see. We do have the balance sheet. Current ratio 1, not as good as the industry at 3. Debt to equity 1.2. We're okay with that. 0.8 for the industry. Net profit margin 3.6. Not as good as the industry, 4.2. And then return on equity 1.7 versus 3. Free cash flow $947 million. What do you got going for it, Chase?
I just want to say, I mean, the big reason this is interesting, you kind of hit it already, but 4 million boomers will hit 80 years old in the next 5 years. And then obviously that should be a big benefit to occupancy at active adult and assisted living communities, which is kind of what we're looking at. But the supply side is also an issue. According to some numbers here that I saw, annual inventory growth in senior housing just dropped below 1%, which is the first time that's happened since the National Investment Center for Senior Housing and Care began tracking that metric in 2006. So there will be just about 4,000 new senior living units developed this year and next year, but demand growth would necessitate 100,000 new beds each year through 2040. I mean, they're looking at senior living demand pool is expected to be see growth of 28% over the next 5 years. So, I mean, supply is not keeping up with demand in this space. I'm like, wow, this could be a great opportunity. Maybe REITs haven't done so well, but I'm going to say, unfortunately, it does look expensive. This REIT has done well over the last 5 years. It is up about 62%. 52-week range here is $56.68. The high is $71.36, and the current price is $67.79. But unfortunately, we go forward for this business. We go out to December 2026. The FFO, or funds from operations, looking at cash flow for this business, is $3.77. Gives us a target sell price of $62.58. I was hoping we had something here, but it's too expensive.
And this could be like a growth investment, which doesn't really fit what we do. But, you know, we'll keep looking because I think it's a good area.
The growth is like decent, though. I mean, I know you mentioned earnings growth, but the FFO growth is about 8% a year. I mean, it's good growth, but not great growth. If this was something we could get around like 12 times FFO, I mean, gosh, this would be an amazing investment.
And maybe we'll see the price pull back to maybe 50 or something. I mean, who knows? We're in a crazy period right now, so we could see a pullback there. All right, we're going to take a quick break. I didn't get to promote the news, that I'll do that when I come back. But coming up company-wise, we got KinderCare, C3.ai, and Brinker International. Stay with us. You listen to Smart Investing with Brent and Chase, so we'll be right back. Alrighty, welcome back to the Smart Investing Show. Right now we have Harrison Johnson, our CFP, but before I get to him about his topic there, I do want to talk about the newsletter, because if you want to be a smart investor, you want to know what's going on, you've got to sign up for the free newsletter, Smart Investing Newsletter. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Topics you'll see in there this week would be a new week and another warning about the risk with the S&P 500. Is your 401k worth less than you would like? Well, we can talk about that for you. I love this one. The federal government is reducing taxes, and some states, unfortunately we live in one of them, are now going to increase their taxes going forward. Stock buybacks could be the highest in over 40 years. Bed Bath & Beyond is returning, but not in California. They don't like California rules. Read about that. And then the markets loved Powell's speech in Jackson Hole, but you want to find out what the but is? Get the newsletter, smartinvesting2000.com. Again, smartinvesting2000.com. Right in the middle of the page, you'll see the newsletter. Sign up. It's free. All right, let's turn to our financial planner, our CFP, Harrison Johnson. Harrison, today you're talking about, I love this, forms SSA-44 to reduce Medicare premiums. I got to fill out a form to do that. Gosh.
So
what do you got?
what this comes in with Medicare premiums, depending on your income, that cost can be higher. It's called IRMA, income related monthly adjustment amount. But the IRMA cost you pay or you incur is based on your tax return from 2 years prior. It seems a little funky that they do that, but the reason they do that is at the beginning of any particular year, let's say, you retire January 2026, they can't look at your 2026 tax return because it hasn't happened yet. You also haven't filed your 2025 tax return yet because that's in April of that year. So the most recent tax return is the one from 2 years ago. So when it comes to retirement, a lot of people, when they're working, they have a certain level of income. And then in retirement, at least in the first stage of retirement, your income might be much lower. But if you go on to Medicare, if they're looking 2 years ago, they might see what you were making and they might charge you some extra Medicare premiums for that. So what this form does, it's a form you file with the Social Security Administration. It's SSA-44. It basically says, hey, I had a life-changing event like work stoppage or work reduction. There's a couple other ones as well, but those are the main ones. And you can put in what your income is going to be going forward to prevent yourself from paying those unnecessary higher Medicare costs.
Okay. Do you have to prove this? Because I'm wondering, what is going on? And I like the concept that finally makes some sense here, but how do you prove it? Work stoppage or anything else? I mean, what are they looking for there?
So, they ask for different things, and what they do is you can put in a number, and then they'll verify it when your tax return information actually comes in. So if you're lying, then they'll claw it back. But for a lot of people, for the first stage of retirement, your income is lower, so this can help out a lot. And with Medicare, with the IRMA tiers, you climb up those tiers pretty quickly. If your income's less than right now $212,000 for a married couple, you're not subject to this. But from $212 up to $400, there's 5 different tiers that you go across. So depending on what your income is, you can climb up those things really quickly, and you could have, as high as an extra $6,000 a year per person. So if you have, 2 people on Medicare, 65 or older, you're paying over $12,000 a year, potentially an extra Medicare premium. So this form can, save you a lot of money.
I thought it was $400,000. They lowered that to $212.
So $212 is the lowest, and then so from $212 to $266, $266 to $334, $334 to $400, $400 to $750, and then above $750. So, but again, from $212 up to $400. That's not quite $200,000 of room. You go across 5 different tiers, less than $212, up there, and then above $400. So if you were making $300,000 a year, now you're in the 3rd tier, paying a few $1,000s extra on Medicare. So if you file this form, say, well, going forward, my income's going to be $150 or whatever it is. Now it saves you a few $1,000 bucks.
It always gets me with all the taxes. It's just it's so complicated. Obviously you have income tax and you're like, oh, okay. Oh, well, payroll tax. Okay. Oh, sales tax. Oh, okay. IRMA tax. What?
It is a tax. Yeah. That's really what it is, because it doesn't do anything to change the health insurance or the Medicare coverage or anything like that. It's purely an extra cost based on your income. So it's an income tax.
Things are just confusing. We talked about streaming earlier, how confusing that is. Now the Medicare thing's confusing. It's just gosh, can't we just have an easy life and just pay 10% of what we make?
Yeah, and in this case, I'm sure there's a lot of people out there that aren't aware of this form, and so they retire, they apply for Medicare, and they get a letter that says, oh, well, your income is X, so that means you have to pay this much for Medicare, and they just do it. So there is this form, but you have to know about it, and you have to submit it to the Social Security Administration, which you can do that online. You can mail it in. There's a couple ways to do it. But I'm sure, there's people out there that pay more money than they need to.
For your clients as financial
sure the government
planning.
doesn't tell you either.
No, I know. They're just like, yeah, we'll take that.
And for your financial planning clients, do they know about this? Could you say, look,
I tell them about it because a lot of people I work with are, getting ready to retire. Right. Maybe they've just retired, and it's a part of my recommendations. Hey, let's fill out this form. I got someone that called me about it earlier today, asking questions because they just retired and they want to submit it. So it's definitely something, because it's like a 1 or 2 page form. It's not that complicated. You just put in what your expected income is going to be. submit it, and they'll take a look at it. It might take a little bit for it to get processed and everything, but
Right.
it's a simple form, and it can save you a lot of money. And it's not cheating. You shouldn't be paying it anyway if your income really is going to be less.
Which is another reason why a fee-based financial planner looks at these things where somebody's trying to sell you mutual funds or life insurance or annuities. They don't even probably know the form SS what?
SSA-44, yeah.
Yep.
I always feel kind of weird saying that.
But they don't know that form. That's what I'm saying.
Right.
So, wow. Well, as always, good information, confusing information, but that's why we need a good CFP, a good financial plan that's fee-based to work with our clients.
Absolutely.
Harrison, thank you very much. All right. Again, that's Harrison Johnson. He is a CFP. He's a financial planner at Wilsey Asset Management. If you want a free consultation with him, go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Or give him a call at the office, 858-224-0004. Again, that's 858-224-0004. And again, that's Harrison Johnson. All right. You ready to do some more companies, Chase?
Yeah, let's get to it.
All right. Let's go to your alumni here, KinderCare. Did you ever go back for a reunion?
No, the one that I went to, I think, was it's closed. It's a different I think daycare now.
Oh, okay. We'll talk about KinderCare Learning. Their symbol is KLC. They're in the education training services industry. 6.3% as shares float. Unfortunately, no PE ratio, which tells me the last 12 months they have no earnings. Price of sales are very cheap, 0.3 versus 1.7. Price of book value, 1.9 versus 2.2. Price of cash flow looks good, 4.8 versus 10.9. And unfortunately, no PEG ratio here. Looking at earnings and sales, nothing here going back. I don't know if they're not reporting or they're all negative.
I was a little bit disappointed. I'll kind of spoil it a little bit. They actually went public in 2024, late 2024.
Oh.
So they don't have 12 months of earnings, unfortunately.
Okay.
We didn't look at this ahead of time to see when they went public. I thought
Yeah.
they'd been around, so they'd been around for a long time. But
Yeah. And again, when we pull these companies out, we don't research them first and try to find good ones or bad ones. We try to find companies that could be of interest, and then we analyze them live on air here. So they don't pay a dividend. No dividend there. Look at the balance sheet. Current ratio, not very good, 0.7 versus 2.1. We'd like to see a little more liquidity there. And debt to equity, you said they just went public. 2.7 versus 0.8. That's a pretty heavy debt load they seem to be carrying. And also, to point out, they got 41% in intangible assets. Net profit margin, a negative 2.2 versus a positive 4. Return on equity, a negative 6.5 versus 11.5. Free cash flow, $42 million versus $270. I have heard that it's very hard running daycare centers because the expenses, the regulations, the insurance, what you got to pay the teachers. I mean, it's a pretty tough business to run, I believe.
yeah,
nowadays.
they have a ton of employees. I was looking at this. They have 43,690 employees. So I mean, it's a pretty heavy base there, and as you said, a lot of costs. I was kind of surprised they do have multiple brands. I'll call it. Obviously, they have the KinderCare brand, but then they have it looks like the Cream School, CREME. I've never heard of that. And then the Champions brand. The Champions brand is before and after school programs. And I have heard this as well, but this was one that I think I read in Barron's or something late last year. They were talking about as people are kind of going back to the office, they do offer, kind of employer-sponsored centers. So they kind of work with employers to provide those daycare services to those employees. The person's argument at that time was, as more people go back to work, this will be a great opportunity. Well, frankly, that has not caught on. KinderCare, since going public, has struggled immensely. The 52-week high is $29.89. That's close to where they IPO'd at, it looks like, or at least where their first trade was. 52-week low, $6.63. Current price, $7.31. I mean, it has just been, if you look at the chart, just since the IPO, straight downhill.
Let's buy an IPO. They always go up, right? Just doesn't last.
I guess not KinderCare.
Well, I'm being facetious.
I
there,
know, I know. But looking forward for this company, you go out to December 2026. I mean, this is intriguing. Estimated earnings per share, 90 cents. That does give you a target sell price here of $14.94. It traded under 8 times the future earnings. I mean, there's value to it, but the question is the balance sheet. Is that going to be problematic? I do wonder, we talked about this last week on air, but are they leasing a lot of their locations? If they're leasing a lot of locations, I don't consider that as problematic as debt on the balance sheet because, you got to kind of have your business somewhere.
Right.
So that is going to be a cost to you. But again, if it's true debt on the balance sheet, I think that could be a big problem.
So what you're saying, I mean, it could be a buy because we got the earnings there, 90 cents going forward, gives you some growth there, but depends on what type of debt they have. Because if it's leases, not as bad, but debt.
Yeah, and I mean, I was disappointed in the short IPO window. I generally would not like to look at a company until at least you have one full year of public information. I mean, they tanked about 20% after reporting earnings. I just wonder if analysts weren't as in tune with this company just yet, which is why I think waiting a year until you have good data as a public company, I think is so important. You don't want to gamble there. This company is also really small, $802 million market cap.
Ooh. Yeah, that's not even $1 billion.
Yeah.
And one thing too that we've talked about it now for a while, is that it is a pricey market, overvalued market, and companies like this come out like, oh, an IPO, let's buy it. They bid up the price, and then wait a minute, it's not worth what was the high? You said 49 or something?
29. But also, I mean, I say it's $800 million, and obviously 7 to 28. 4 times, so that would have been about $3.2 billion. So,
yeah.
I mean, it was decently sized, but the decline in stock price has just decimated the size of this business.
Yeah, I just, again, we like to kind of watch a company when it comes out, get some good numbers for it, and this is why. Maybe you miss something by doing that as an investor, but, again, if you want to gamble, fine, go ahead and gamble, but I want to invest. I don't want to gamble and, I shouldn't have done that.
Yeah, and I mean, I have two kind of maybe conflicting viewpoints long term for these daycare centers, right? Number one, we know the people having kids, it's very low historically.
That's true.
That's going to weigh on the negative. On the other side of it, though, we have less stay-at-home parents than we had in the past. So kids got to go somewhere. So I mean, is there that kind of counteracting force that maybe enables KinderCare or daycare centers to keep growing over time? I don't know, but I mean, also too, I talked to a lot of friends who takes care of the kids. Grandparents.
Parents, yeah.
Yeah. So, I mean, it's you're competing with a lot of other things, not other daycare centers. You're competing with family. You're competing with stay-at-home parents. I mean, there's other forces that play here. So, I mean, I wanted to like it, but it just doesn't seem like it'd be worth the risk.
I like the senior housing center more than this. Yeah.
Conceptually, yeah. The valuations on this is a lot better than the senior housing.
True. Okay. Well, let's talk about, AI.
AI.
It's so popular. Everybody loves AI. Got to buy AI. So we bought a company. Do we know? I mean, the company is C3.ai. What does C3 stand for? Do we know? Did you ever find that anywhere?
So actually, ChatGPT did. Might as well use AI for AI, right? But this is kind of funny. It was founded in 2009. I mean, this
2009.
company. Yeah. Well, get this. This company seems to just try and follow the trends to maybe get some popularity in the stock market. It was originally founded as C3 Energy. Then it went to C3 IoT, which is the Internet of Things. And now it's C3 AI. Let's just keep changing our name until something sticks.
Had it been around back in 2000, it would have been C3.com.
To be fair, it did IPO in 2020, so I think it probably IPO'd as C3 AI, but it's just kind of funny that they've changed that many times.
Whatever's exciting, let's do it. Yeah. So let's take a look at the company again. The company is C3.ai. Their symbol, I don't know how they got this one, AI. They were pretty fortunate to get that. They're on the software infrastructure. The float, the shortage on the float here, 22.3%. That is high. We get kind of nervous above 10. Only 54% institutional owned. So a lot of small investors, for some reason, have picked this up. Probably as a gamble on AI.
Probably because of the ticker. Oh, AI is hot?
Yeah.
Let me type in AI.
Yeah.
Oh, I got to buy this one.
I think you're 100% right there. I think that's what they're doing. Price earnings, nothing there. So they don't have any earnings. The industry's at 48. Price to sales, 6 versus 7.4. Price to book value, I will say it looks good, 2.8 versus 11.1. So we found something good here. But no price to cash flow. So I'm assuming they have no cash flow, no PEG ratio. Looking at the growth earnings, nothing on the earnings. The industry was up 5.4%. Here's another positive thing. Sales, they were up 19.6% versus 6% for the industry. But the 5-year earnings per share growth estimate from the analysts, well, they say a negative 178. So that's not a good thing there. They do not pay a dividend. C3 does not pay a dividend. We do see on the balance sheet, they got a lot of liquidity here, Chase. 6.9 is our current ratio versus 2.1. Whenever you see that number high, like, what are they doing? Because they should be investing that money somewhere, doing something with it. But that's too high of a current ratio. And even their quick ratio, which is just your cash and short-term investments, is 6.9. So they're sitting on a lot of cash. No debt. That's another positive. Net profit margin, here's a problem. Negative 74.2%. Industry's a positive 15. Return on equity is a negative 34.4. Return on invested capital, negative 36.9. Free cash flow, negative 44. That's probably $1,000 there versus $44 billion positive for the industry. So nothing I can say good about this. I've had a couple maybe positive, but not enough to say let's buy this AI company. What do you got?
I mean, I thought there was maybe some potential here. I mean, again, if things are falling, it's like, well, maybe finally something like this becomes a value opportunity. And this stock has fallen. I mean, they plunged nearly 32% in the pre-market last week after they issued weak guidance for the first quarter. Year to date, the stock is down 49%. The current price for C3AI is $17.50. 52-week range, the low is $14.70 and the high $45.08. But that doesn't tell the full story. We talk again about another problematic IPO. I say that because they IPO'd back in 2020. They then climbed to $183.90.
Oh, wow.
183 down to 17. I'll tell you, it's not a good return.
Yeah, but people buying it. Oh, AI, gotta buy it. It's gonna go up. And they were right for a very short time frame. But now it's been devastated from, you said 180 down to 17. That's just a huge. What's that, like 90% drop?
Yeah, I mean, the thing I look at it is, I know you gave the price of sales, but I mean, this company, it just doesn't seem to be very large. I mean, it looks like sales were about 70.2 to 70.4 is what they guided for in the current quarter. I mean, that's not a huge sales figure for a company that has a $2.27 billion market cap. And if you have this company, it's like, what do they do in AI? Everybody can say they're in AI, but what do they do? They say that they offer like business solutions or something using AI. What does that mean? I don't know. And D.A. Davidson, actually, they just downgraded the company as well. And they said that they had previously lacked conviction around the durability of growth, given an increasing reliance on non-reoccurring revenue. That's concerning to me because if you're a business, right, you're like, oh, I should probably be using AI to improve my business. And then they sell you some product that's not like an ongoing subscription model or something. It's like, well, that wasn't very helpful. I don't need to buy it again, right? Having non-reoccurring revenue in a potential fad or a potential area that is hot like AI, where actual other competitors are going to come in, could really decimate a business like C3AI if they don't have a strong product.
And I don't think you've given the earnings going forward yet, have you?
No, I mean,
I see them, but I'm going to let you give them.
there are no earnings. I mean, you go out to April 2027, you're looking at a loss of 32 cents for the year. I mean, that is better than a loss of 60 cents this year, but again, you're still losing money on this business. And again, I don't know who their competitors would be. They're obviously not like an NVIDIA. They're not making the chips for it, but again, using it as a service. I mean, are they like trying to compete against like an OpenAI, or I mean, what are they offering their clients is the big question.
Yeah. And it's just, again, they did well as a hot stock. And then that's why you tell people, don't buy the hot stocks, because this can happen to you. You buy it, goes up, you're all happy. Oh, I made so much money. And then it just, the bottom falls out. And I don't see this company going much above 17 going forward. I mean, and they'll probably change your name. The next thing comes out. What is the next thing? Quantum computing. They'll probably change your name to someone that a few
C3
years.
Quantum.
Right. But unfortunately, exciting company for people. Gambled on it. Congratulations, made money, but you probably lost money because
you had to gamble on it and get out in time. If you gambled on it, now you've lost money.
Exactly. So let's talk about some food companies here, because we always like talking about them. I like them if they're doing well. I think we found one here that has actually done pretty well. The big question, again, we don't know until we look at it. Is it a good buy going forward? And we're talking about the company that owns Chili's. Let me get to the right screen here. That company is Brinker International. Their symbol is EAT. I love that. EAT. Can't miss that one in the restaurant industry. Disappointed here. Shorts are 17%, so a lot of the shorts think this stock will fall. We do see they have a nice PE ratio, 18.1. I say nice because the industry's at 30.5. Price of sales, 1.3 versus 2.4. Price to book value, 18 versus 17. Price of cash flow is 10.2 versus 16.7. And the PEG ratio, looking very good. It's 0.9 versus 18.5. So that's a positive there. Now, I can't believe these earnings. I mean, I'd want to look at the income statement because it shows that earnings per share change over last year up 145%. Either they had some big write-offs prior to that or something happened because the industry was only up 0.6%. The sales for Brinker International increased by 21.9 versus 4.2. That's a positive. The analysts, they give it a 5-year earnings per share growth estimate of 17.1% growth on the earnings per year versus 6.7. So this is looking pretty good. I thought for sure they paid dividend. No dividend paid.
Really?
Yeah, it's and I think they used to, and then now it's it's gone. The balance sheet, and again, I think they have franchises, I believe, don't they?
Yeah, I mean, that's the interesting thing. I was kind of looking that up. According to, again, ChatGPT, it's about 60 to 70% look to be company-owned, actually.
And that's why the weak balance sheet, current ratio 0.3 versus 1.1 for the industry, and debt to equity is 4.6 versus 1. It's because they don't have a lot of assets on the balance sheet because they're a franchise. So
yeah, well, I really have. I don't know why I didn't think about this for so many years. But again, if you have a business and you're leasing it, right? I mean, frankly, our debt to equity for our company would be atrocious. Number one, we're asset light, but we have maybe given too much. We still have a 7-year lease term. That would all be debt on our balance sheet.
Yeah.
To me, your lease is not really debt. It's almost like more of an expense in my mind because you're paying rent, right?
Right.
But the way that you carry it, it's debt for a lot of these companies. So, I mean, if you look at Chili's and they have these lease obligations of, multiple $1 billion, I mean, that could really skew that debt to equity ratio.
Yeah, and that's why you got to do the deep research to look at it and just understand the numbers. Because, again, we always say people can repeat the numbers and say the numbers. You've got to understand what they mean, and that's why we try to do this, is try to help you explain these things so that you don't get burned on something like, oh, I didn't know that. But the net profit margin looks okay for Brinkers. It's 7.1 versus 7.9. Return on equity, I think this shows they have a very low equity. I'm going to look at the balance sheet, I think, while you're looking at the earnings here. But the return on equity, 103%. So I bet you they have very low equity because, again, of the franchise model. And return on invested capital also is very good. That's 20.8. So, let me look at the, where did it go? The free cash flow, $414 million versus $2.9 billion. So that's okay. Depends what you got going forward, and I'll take a quick peek at the balance sheet if I can find it.
Yeah, I mean, I'll let you kind of pull that balance sheet up, but looking at the current price here, we'll have a further conversation around the balance sheet when you get it. But the current price for Brinker, again, their ticker symbol EAT, is $150.40. 52-week range, the low here is $68.45, and the high $192.22. I mean, the stock has just done phenomenally. Over the last 5 years, it's up 283%. So, if you're a big Chili's fan and you like going there and you bought the stock, congratulations. Also, too, they own, I guess, Maggiano's is the other one, but I think it's predominantly Chili's.
Is that? No,
I think a little Italian.
The Italian. I was thinking of Macaroni Grill, I think, is the other one I was thinking.
Yeah, no, I not that one.
Yeah.
But going forward to June 2027, estimated earnings per share here, $11.68. It will give you a target sell price of $193.88. So it's a little bit over 13 times the future earnings. That would probably put it in the hold category at these valuations, unfortunately.
Yeah, and I'm looking at the balance sheet, trying to get something out of here. I mean, you do have, where'd the debt go? Long-term debt's $1.6 billion. Their total assets are about $2.6 billion, and they have very little cash. Property, plant, equipment's about $3.9 billion. So that is kind of surprising because for a franchise model, well, I guess they only use about 30% of the restaurants.
Well, so here's the issue, right? I mean, it's like I've been saying, these leases. Well, so their long-term or their total liabilities as of June 2024 were, last year I can look at, looks like June 2025. Their total liabilities is $2.3 billion. $1.2 billion of that is capital leases.
Right.
So they have all their leases on the books. So again, like I'm going to use the Chili's here in Scripps Ranch. They don't own that. They're leasing that building.
Right.
So let's say they have a 10-year lease on it. That's 10 years worth of lease payments that you have to carry on your books as debt. That debt to equity might not be that bad if you actually then back out those capital leases.
And what surprised me too, as I said, is gross property, plant, and equipment as an asset's $3.9 billion. I didn't think it was going to be that high. So that's a positive.
They probably own some of the buildings.
Some of the buildings, probably a corporate office. Yeah, I mean that's quite a bit on the asset
And I just kick myself because we looked at this company during COVID.
I know I wasn't going to bring that up.
Yeah, but we didn't buy it because of the balance sheet, and
Yeah.
I don't know why we didn't think about the capital leases as maybe not like real debt. It's kind of like when you look at a bank, right? I mean, their balance sheet's going to be skewed. Well, if you have a company that has a large amount of leases of buildings, I mean, I don't want to say you should totally disregard the debt to equity,
Right.
but you should understand that debt to equity, and you might be able to kind of actually come up with a more legitimate debt to equity by understanding what those leases look like.
Yeah. And again, we share that with our listeners because we want to let you know that investing's hard. It's not easy. It's not just throwing the dartboard and getting something. I mean, we said we made a mistake by not buying Brinker back during COVID because we're concerned on the balance sheet, but didn't really quite understand the franchise model.
I was going to say, not even the franchise, the company-owned model is the problem.
Yeah, that's true. So
Potentially.
All right. Well, there's the closing bell. Thank you for listening to Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. That's smartinvesting2000.com. And when you're there, sign up for that free newsletter. You'll be a smart investor when we read that newsletter. Thanks for listening. We're back next week right here on the Smart Investing Show.